Well, holy smokes, things are getting a little bullish in here, and oh boy, we gotta talk about it because something big just happened from the Fed. You gotta know about it, but you also gotta know, what is this potentially gonna mean for next week? Is it gonna stay bullish, or is there a potential oopsie-doopsie coming? Let's talk about it, but first, remember that yesterday and the day before, I made videos saying mega bullish, and then why the Fed is about to explode markets up. And in these videos, I explained that the Federal Reserve has a chance of sticking a soft landing. All they need to do is not F this up by going, frankly, too slowly. The slower they go, the more bearish it is because they increase the odds of a big layoff cycle coming. I know it's not here yet now, but it's coming. Companies are on the edge of layoffs. And we'll talk recession in just a moment. So I thought, okay, they gotta be dovish here. So they're either gonna go 50 and be dovish and by virtue of going 50, or they're gonna go 25 and have a really dovish summary of economic projection. So I basically said, all right, they're gonna be dovish and markets are gonna be happy about that. Now watch the video because there's more detail and I go into the projections, but I wrote why the Fed is about to explode markets up. And literally, I wasn't expecting this, frankly, to happen this quickly. I thought it'd happen next week, but boom, markets shot up today. But it wasn't because of my video. It was because of Nikki leaks. See, yesterday, we had a 14% chance of a 50 basis point hike. And the Federal Reserve doesn't seem satisfied with a 25 basis point hike being priced in by markets. Yesterday, after CPI, PPI data, which remember I said, hey, look, I don't actually think it's bearish. Yeah, you had a little bit of an uptick in airfares and lodging. Who cares? It's a very volatile number. And then you had the super lagging owner's equivalent rent when leading indicators of rent are still saying we're still in trajectory down. Who cares, right? And I'm not trying to I mean, think about it. I'm a bear, but that's actually a bullish way to analyze that because I think it's the correct way to analyze it. Like, I don't look at stuff and go, well, I'm a bear, so I'm going to try to find the bearish way to understand this. I just look at the data and I go, oh, okay. So yesterday we're at like 14 basis points at 25, and I'm like, oh, this is going to increase the odds the Fed makes a mistake, and then you have a greater chance of recession. I don't want a fucking recession. Look, yes, if we have a recession, some of my plays, they're not shorts, are going to do really well, but they'll be fine as well, even if we don't have a recession. You know, I'm positioned for both scenarios. But a recession is really bad for like startups and trying to grow businesses, right? So I don't like that. That creates a lot of pain. Economic gloom is depressing. It's bad. So yesterday we're just at 14. I'm like, this isn't good. And then, lo and behold, we get a Nikki leaks drop. Now, when have we ever had a Nikki leaks drop before? And who the hell is Nikki leaks? Maybe you don't even know who that is. Well, it's Nick Tiermos of the Wall Street Journal. He usually sits next to the New York Times girl at the FOMC meeting, but he didn't last time, which makes us wonder if there's like some relationship drama happening between Nick and her, Smilyak. That's really a topic for a different video. Maybe not a video at all. But anyway, Nick T, on June 13th, just about 30 hours before the 2022 June 15th FOMC meeting, dropped a little Nikki leak. Now, why did he drop a Nikki leak? Well, it's because markets were pricing in just a 35 to 45% chance of a 75 basis point hike. Well, the meeting was in 30 days. The Fed's in blackout window. They can't just tell Bullard to go hawk. Like, they want to give us a 75 in June of 2022, but markets are only like, nah, 35% chance we get a 75, and the Fed's like, no, it's going to be 75. But they can't say it because they're in blackout. So what do? Nick T, tell the world we're doing 75. Fed likely to consider 75 basis point hike this week. June 13th, posted at 7:47 p.m. It's like frantically get the article out. Just 30 hours before the meeting. The day before day one of the meeting. Why? First of all, that's why he got the name Nikki Leaks. Second of all, why? Well, they do this on purpose. They do this on purpose because if the Fed sends this signal and then like something breaks, like I don't know, bank fails or whatever, the Fed can U-turn at the meeting 2 days later and Nick T was wrong. not the Fed. So it keeps the Fed credibility high because this is just a journalist saying likely, right? So, like, there's plausible deniability here that there wasn't some, like, signal chat or text message or phone call or in-person, hoodie meeting. So anyway, then it actually happened again during the banking crisis. During the banking crisis for the March 20th meeting, people were like, oh man, the Fed's not gonna hike 25 because of the banking crisis. But the Fed they bailed out the banking crisis, right? They insured everyone's deposits. So we get this article, Federal Reserve faces tough decision on rate increase just hours before the Fed meeting, and Nick T basically signals that Jay Powell's about to announce a 25. And sure enough, the 25 gets priced in. Previously on that June 22 one, we were at 35 to 45% chance of 75. That went to like 95 after the Nick T article. So that's why people pay attention to Nicky Leaks and why we call him Nicky Leaks, because when the Fed's during the blackout period, this is what you get. But you could also get commentary from other people like Dudley. Dudley was the former New York Fed president, doesn't work at the Fed anymore, but Jay Powell might be like, Bill, bump it. And then William Dudley goes on the news channel. I think there's a strong case for 50. The labor market's slowing down. We really ought to cite what Jay Powell said at Jackson Hole, not seeking any further softening of the labor market. He didn't call me or anything. I'm just basing it on, what he said a few weeks ago. It's all rigged. That's why I actually think it's hilarious, because it's just like, if you read it like the book that I'm reading you, basically, it's pretty straightforward how the game is played. Okay, cool. The question is, how do you trade around this? Okay, well, that gets a little bit more complicated. First thing you have to know, and I'm going to keep this one short because you've probably already heard about it. Yes, Nick T dropped a piece, okay? Yep, he dropped a piece right here. The Fed's rate cut dilemma. Okay, should we start small or big? We don't know what to do, blah, blah, blah. They talk about, hey, we don't want to let the soft landing slip through our grasps, like slip through your fingers. Fine, I'm just bottom lining this article for you, okay? And then over it here, it says, right now markets expect the Fed to cut by more than 100 basis points this year, but if they only go with 25, they could cause the market to crash, which would be bad. And they don't want the market to crash, so I write, bump it. But there's also the risk if they go 50, they might pump the markets too much and they might cause inflation. So there are some issues, right? So they kind of mention like there's this duality here. And also, if we go 50, let's be clear, that doesn't mean November and December are going to be 50. We're going to be data dependent. Fine. So you could be 50, 25, 25, or 50, 50, 25, whatever, right? Fine. They're basically outlining what the Fed's going to do for you next week. And just in case this wasn't clear enough, just go to the last sentence, okay? Everybody knows the last sentence is where they're like leaving their final thought, which is what they want you to walk away with. There it is. Last sentence. We're at the point where you might say, I could go either way, 25 or 50. This is quoting people. This quote is like you're quoting the doubters at the Fed. Right? Where like you got the Esther George or Bullard or whatever, like, I don't know, do we really want, do we really want to encourage 50? Are we going to go with 25 just to be conservative? And then it's like, actually, we'd be okay with either. But that's not actually the last line. Keep in mind, Bullard not at the Fed anymore, but he still kind of circulates and provides commentary and opinions. So the last line here is, but I think the risk management has shifted to the labor market and favors doing a 50. The last line of the article is, we're getting a 50, boys and girls. This is also somebody else who used to work at the Fed. See, former Fed vice chair. So I'm saying they call up their cronies and they go, do all the interviews and make it seem like, we're kind of 50-50, but we think it's better to do 50. Okay, so we're getting 50, basically. This is what this is, all right? So now the question is, well, how do you play this, right? Like, all right, well, this is a little complicated. In order to understand how to play this, you have to understand the Fed put. Now, this is not the easiest to understand, but I'm going to try to outline it as simply as possible. And then I want to show you where you can get Fed puts. And I'll explain what that is too. First, you have to understand the recessionary cycle. People are like, Kevin, there are no layoffs. No shiitake mushrooms, okay? We're not there yet, okay? This is where we are. We are right here, stage 0. Pricing power wanes for goods and services, and labor becomes more available. We're at stage 0, okay? Then 2 things can happen that are bad. You can have a sustained shock, like, I don't know, a war, a banking crisis, something, an election, something that introduces a lot of volatility, uncertainty, panic, and then you get a market correction, right? These are obviously, frequently go together. If you get a market correction, you get stock declines, companies suddenly rapidly ramp up cost cutting, like Verizon and Microsoft, they're doing layoffs over the next few months. You could get a lot of those. Then the unemployment rate exceeds 5.5%, 2% above the prior low, and then you're probably in a recession. Stocks fall, risk assets like bonds and gold go to the moon. Gold's already rising because of this. Bonds are already rising because of this. Because, frankly, there was a note this morning from some economists. They're like, the futures curve is really starting to price in more of a recession here. Like, the Fed really needs to start moving like now because it might already be too late, right? And then markets basically, in a recession, markets basically continue to fall and bleed out and crash until the Fed capitulates, which they did in 1989, March of 2001, February 2008, December of 2018, March of 2020. At that point, and this is the hard part, at that point you switch from bonds and gold to risk assets at the point of Fed capitulation. That's when you go all in on risk assets, right? Okay, so this is in recession. So in recession, you go all in at Fed capitulation. Or in a soft landing scenario, you buy when the Fed comes in with the Fed put, which is basically saying we're going to stop the market from selling off by we're going to talk the market up. And this is why I made that video yesterday saying they're going to talk the market up, because if they talk the market up, less odds of going to stock declines, less odds of cost cutting, less odds of unemployment going up. It's a simple game. So the question is that Fed put going to be enough? Now, me personally, I will be clear here, my bullishness level edged up a little bit. I've actually given a heads up of this. Somebody asked me last week, and I've made it clear on videos, that if we get a 50, would that make me bullish or bearish? Because a 50 might signal distress. And I said, no, it would make me bullish. The reason it would make me bullish is because the Fed is actually responding to the problems I'm already seeing. But it might not be enough. We don't know. I think I will have more personal clarity when we get closer to the election. I don't have to wait for the election. I really don't care about the election outcome. You know me. I'm in the middle. The University of Michigan this morning says people are pricing in a Harris victory. I think that's actually going to get a lot tighter and closer as we get closer. Okay? So everybody should do what's best for their own portfolio, obviously. My take is I want to see what happens over the next 6 weeks to figure out, am I going to tilt over 5 on the bull scale, the bear bull scale, or am I staying under? And here's why. First, we have stock blackout periods for buybacks that start today before Q3 earnings. Look at Adobe today. Adobe missed by 1.4%. That's it. A 1.4 percentage point miss. Stock down 8.7%. You get that sort of pain happening in the tech and AI sector, it ain't good. It's that CapEx spending dries up, you're going to have layoffs. It's going to be painful. And indebted companies like Oracle are going to freak out. But mortgage companies might do really well. Wow, who's been talking about mortgage companies potentially doing well? United Wholesale, LDI, Rocket Mortgage. It's still early on these plays, my take. But the point is, you have blackout periods, election volatility, and earnings and Q4 guidance coming up, as well as additional jobs data and a few more reports that we're going to get. at the beginning of October, and frankly, even at the beginning of November, you'll get another jobs report. You get one more CPI report, 2 more jobs reports, and then a bunch of other data in between then and now, specifically with earnings. So I think there's a lot to digest, and I don't see a rush to dive in. I understand on a very green day today, it's like, oh, well, you could be all in. Dude, I got a lot of exposure to the mortgage companies. We're kicking ass today. I also got a lot of exposure to other things that are doing well today. It's great. And they're not short. I'm not short. The only thing I have exposure to is a small short Bitcoin position. But it's so small. It's way offset by these huge moves in some of these other stocks. So I've just positioned towards what I think will do well in a recessionary time. This is different. Or a soft landing. Okay, so then the question becomes, all right, well, if everybody's now pricing in the Fed being dovish, which they're not doing, it's not great. I mean, we're only at a 52% chance of a 50 basis point cut right now, so you're still 50-50. Frankly, you need another Nikki T leaks article. Probably like Monday or Tuesday, expect another Nikki T leaks article, and then it'll slam dunk it, and it'll get a like 80-90% chance of a 50. Great! Fantastic! That should be great for my plays as well. I talked about those in the course member live streams. So now, what about for you? And what do I think the market direction is going to be? This is a big one. This is important because I think something might happen next week, and I'm going to explain it. But first, I want to just take a brief moment to say, check out stockhack.com. We are not going to be able to take everybody immediately. So if you are interested, go check out stockhack.com. I just want to explain really quickly that we are going to have partnerships. We're already building our partnerships with either Interactive Brokers, JP Morgan, or both. There's a chance we might just take our higher, sort of the highest net worth custody clients, and we might work with them and JP Morgan, and probably most of our clients are going to be with us at Interactive Brokers. So we'll have both. It just sort of depends on where your portfolio positioning is and what your goals are. But we have a relationship with both, and we're very excited about those relationships. But what I just want to be very clear about with this service is StockHack, which you can sign up for, join the waitlist at stockhack.com. It's coming October 1st. This is not designed to be some, we're going to day trade for you and beat the market and speculate. No, none of that. This is not a hedge fund. What this is wealth building. How can we look at your portfolio and say, hey, you should consider these products that JPM offers. You should consider bonds, a money market, a CD, real estate. It totally depends. Everybody's situation is different. Somebody asked me this morning, Kevin, should I sell $100,000 of stocks to go buy a wedge deal in real estate? I'm like, well, it depends. Is the wedge deal in Austin, Texas? Maybe it ain't that good of a wedge right now. It's a bad timing right now. We could look at the deals and show you the comps. We do that. That's part of what we do at StockHack. Should you put that money into funding your child's college savings plan? Should you, buy a smaller wedge or go all in on that wedge? I don't know. There's no blanket advice. You can't give blanket advice. You all know that. So what we believe is we've created a very compelling product where after a join fee, you pay $420 a month flat fee, no hourly fee. Yes, it's not the cheapest service, but that's because I want it to be the best service. So that way, anytime you're thinking, Kevin, should I get the new iPhone? Kevin, should I renovate this house? Kevin, should I hire this contractor? My team in the office with me can help you come up with that conclusion. And if you do want us to either invest on your behalf, like do the diversifying for you and keep your portfolio balanced, we can do that. That's a discretionary account, or a non-discretionary account where we work together on it, but ultimately you enter the trades, right? We can do that. Both of those are possible. And we charge an annual asset management fee for that, but you don't have to custody your assets with us to get the service. So just be clear, this part is optional. It does come with benefits. So this is very exciting to us. So if you're interested in a personal wealth plan and actual licensed financial advice, give it a try. You could cancel at any time. I just want to be very clear about that. Let's say you join And then, you know, it's like September 30th and you're like, okay, I joined, or October 31st, and you're like, hey, you know what? I got what I needed. I want to cancel. There is a 30-day cancellation window. And so basically you pay one more month and then you're done. All right. And that's just so we can transition to make sure we're closing out all of our disclosures and we're properly closing out with you, which is totally fine. But I want people to know that, like, you could try it, and if you don't like it, it's okay. But there is going to be a limit to how many clients we can take. So I just want to be clear about that. So what do I think about next week? And this is a little bit of a warning for next week. Honestly, I think markets are like fully pricing in a full dovish Fed right now. And we might have a little bit of a buy the rumor, sell the news. Now that I've put all this together, I think about it. I'm like, okay, so you're going to get a dovish Fed. We already know that. There's a chance the buying in stocks may have already happened. And then what do you have to look forward to? Oh, crap. Earnings are coming up. Profit taking. Stocks down. I don't know, but it's something to watch for. And remember, the Fed doesn't want markets to skyrocket because they think that'll be inflationary. They just want them to go up and be stable so you don't have a recession. Anyway, full breakdown for you. Hopefully you found it helpful. Thank you so much for considering StockHack.com. Thank you so much for subscribing to the channel here. I love y'all. We'll see you in the next one. Goodbye. And good luck out there.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than HouseHack, nor am I presently acting as a market maker. Make sure if you're considering investing in HouseHack to always read the PPM at househack.com.